For Morningstar, I'm Karen Wallace. After the Brexit vote introduced significant volatility into the market, investors might be more interested than usual in doing a mid-year portfolio checkup. Here to discuss some traps to avoid if you're looking at your portfolio at mid-year this year is Christine Benz. She's Director of Personal Finance for Morningstar. Christine, thanks for being here.
Karen, great to be here.
So the first mistake we want to discuss is getting too into the weeds with your investments. What advice do you have for investors to not sort of miss the big picture when they're looking at their portfolio?
Well, on Morningstar.com, we provide a lot of analytics for looking at your portfolio. If you've got a portfolio saved on the site, you can use our X-ray tool and compare your sector weightings to the S&P 500, look at your style box positioning and so forth. But I think before investors get too focused on their portfolios and their allocations and how various holdings have behaved, it's better to take a step back and think about the plan. And is the plan on track? That's really the main question you want to ask when you do this sort of portfolio checkup. So if you're in accumulation mode, a couple of benchmarks that I think are handy come courtesy of Fidelity Investments. They put out some savings targets that people can keep in mind when they're determining whether they've saved enough for retirement. So the Fidelity data suggests that by age 35, people should aim to have saved twice their current salaries. By age 45, they're looking for 4 times current salary saved. And then by age 55, 7 times current salary. So I think that that's just kind of a handy rule of thumb. It may not fit in every situation, but perhaps a good starting point to see if your current savings rate is on track. If you're someone who is getting close to retirement, at that point I think it's reasonable to use what's called the 4% guideline when looking at your portfolio. So you're looking at your current balance, you're taking 4% of that balance, and try to decide whether that amount plus any amount that you expect to get from Social Security or a pension, whether those two amounts together will provide you with a sustainable living stream of income in retirement. If it turns out that you're not anywhere near there, then you can look at some other perhaps levers to pull. Perhaps you'll need to continue working, or you'll need to step up your savings rate, or some combination of those things. But the starting point for any portfolio review should be what I call kind of that wellness check, just to see if you're on track.
And another mistake that you recommend investors avoid is sort of just assuming that a hands-off tack is the way to go. I mean, investors are sometimes admonished for reacting to bad news, but sometimes that's not the way to go.
That's right. I mean, when you go through a market environment like we just had with Brexit and all the volatility that was happening, every pundit you heard from pretty much was saying, don't do anything right now. And that's good advice for people who are in accumulation mode. It's better not to peek at your balance when it's down. You're more inclined to get in there and make changes that in hindsight you'd like to undo. But if you're someone who's getting close to retirement, if you're someone who is post-age 55 or 60 plus, I actually think that changes may be in order if you've been a very hands-off investor. So an example I would give is if your portfolio was 50% equity, 50% bonds back in 2009, due to great appreciation in the stock piece, it's probably about 75% stocks today and about 25% bonds. Meanwhile, you're 7 years older and 7 years closer to retirement. If you haven't revisited your asset allocation for several years, there's a good chance that your portfolio may in fact need more bonds. And I think the recent market volatility should be an impetus to get in there and revisit that asset allocation. You can use Morningstar's lifetime allocation indexes to help see if you're right in the right ballpark in terms of your asset allocation, or simply use a good target date fund geared towards someone in your age band as another benchmark. So look at the target date series from Vanguard or T. Rowe Price. See what they're recommending in terms of bond allocations for people your age. But definitely do that check on your asset allocation. Sitting still isn't always the right prescription.
Mm-hmm. And sort of related to that, another mistake to avoid is focusing too much on short-term performance. What has done, when you're looking to sell, focusing on things that have done badly, versus what has performed well.
Exactly, sort of the performance chasing mentality that a lot of investors tend to fall into. So if you're reviewing your portfolio, reviewing your positions, there might be a natural tendency to let the holdings that have performed well run, or perhaps to add to things that you didn't have that have performed well. One category a lot of investors might be looking at today would be precious metals equity. We've seen tremendous gains in that part of the market. There's no telling where precious metals equities will go from here, but chances are you've missed a good part of their upside at this point. Long-term government bonds are another category where we've seen really explosive gains recently. But this is another area where, in general, I would urge investors to exercise extreme caution. Long-term government bonds, while they are, when we look at things that are the best diversifiers, and you recently did a piece on this topic, long-term government bonds look really good from that standpoint, but as standalone investments, they're incredibly volatile, and they're not necessarily what people think of when they're looking to the safe part of their portfolios. So for most investors, I think some sort of high-quality intermediate-term bond fund is just fine. They don't need to gravitate to long government bonds. At the other end of the spectrum, when people are looking at parts of their portfolios that have performed really poorly recently, one area that might look like a natural to put on the chopping block would be international equity investments. We've seen pretty dramatic underperformance versus U.S. equity investments over the past year, in particular, a real dislocation there. Some investors might be inclined to give up on international equity, but I think it's worth keeping in mind that oftentimes the thing that looks ugliest from a performance standpoint a year or two from now may be the thing that you're the most thankful that you have. So for young investors, I think it makes perfect sense to have a globally diversified portfolio. You may want to back off of the foreign allocation a little bit if you're closer to retirement, but nonetheless, I would still maintain international equity exposure going into retirement. Investors may be also losing faith in some of their small and mid-cap holdings. We've seen underperformance there. Arguably, that's an area that investors should stick with. They should maintain at least some exposure to small and mid-cap stocks, even though we have seen some underperformance.
And the final mistake that investors should make sure that they try to avoid is to assume that just because the market has mounted a comeback, that there's nothing in their portfolio that they could utilize from a tax loss selling standpoint. Could you explain a little bit about how that works?
Sure. So one of the silver linings that investors sometimes have in weak market environments is the opportunity to prune holdings that have depreciated since their initial purchase. The virtue of doing that is that you can take those losses, assuming that you hold this holding in a taxable account, you can take those losses and use them to offset capital gains. So if you have winning holdings elsewhere in your portfolio, or if your losses exceed your gains, you can use them to offset up to $3,000 in ordinary income. So this is a strategy that I think investors can take advantage of in down markets. Some investors might say, well, this whole Brexit thing seems to have blown over, at least for now. The market has come back. So maybe those tax loss selling opportunities have evaporated too. Not necessarily so. So if you look out over a 1-year period, there are actually quite a few categories that are in negative territory over that 1-year trailing period. International equity funds would be toward the top of the list. Emerging markets, specialist type funds would be in that group. Certainly the energy sector, though it has come back a little bit so far in 2016, many investors' energy holdings are still underwater. That would be another category to look at. More recently, we've seen healthcare stocks be under a bit of a cloud, specifically some of the biotech stocks. So if you have a fund that tends to own them, or maybe you own some of those biotech stocks straight up and you bought them fairly late in the rally last year, that might be another area to consider doing some tax loss selling. It's also valuable to remember that you can maintain economic exposure to those sectors. You can't rebuy the same thing that you've just sold for a tax loss sale, but you can swap into a security that has like-minded exposure. So maybe you are selling out of some sort of foreign large cap value fund that is depressed and you're buying a foreign large cap value ETF. That would be a perfectly allowable swap.
Okay, great advice. Thanks so much for being here.
Thank you, Karen.
For Morningstar, I'm Karen Wallace. Thanks for watching.